If you spent 15 years of your life grinding away to build your business, you want to reap the benefits of that in some way. So you could either sell your entire company altogether to maybe a strategic buyer and be done with it and move on, or you can sell a majority of your business to a private equity fund at a value you think and they agree on, or vice versa, is fair. And so you can take some money off the table and start building that big house or buying that Maserati or whatever.
Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhardt, and Emily Sander.
And here we go, our inaugural episode of the Private Equity Experience Podcast. I am Emily Sander, and I'm joined by my illustrious co-hosts and co-authors, Ed Barton and Rory Liebhardt. This episode is going to be quick intros from us, so you know who you're hearing from. And then we're kind of going to do just a private equity 101, get the lay of the land, get the foundation that we can build off of from there. So by the end of this episode, you will know at a high level what private equity is, what it is not, who the major players are, and how a PE firm makes their money. So that's what you can expect from this episode. So first off, let's do lightning round intros and introduce ourselves as it pertains to private equity, and then maybe do like a fun fact, memorable moment, or something like that. So I'll go first. My name is Emily Sander. I started my corporate career at large companies like Microsoft and Amazon. I was a tester for the original Kindle device, so the e-reader, when that was a brand new thing in '07. And then I worked for a series of small to medium private equity-backed businesses. And those were all pretty much in technology-based businesses. And so I got opportunities in leadership roles and grew my career from there. And it culminated in a role as chief of staff for a digital marketing company. And that company was backed by a PE firm that I had previously worked for, and they had called the CEO and myself back into their investment. In 2021, I started my full-time coaching practice and have built that up. And because I was a chief of staff and I have coaching credentials, I specialize in coaching for chiefs of staff, for their principals, for executives, and companies who are looking to set that role up. So that's what I do full-time. I also do podcasts and write books, and that is me. My memorable moment is mid-career. I was at a board meeting and someone was like, Emily, you know how to build an international client management team from scratch, right? In my head, I was like, no, I don't. But out loud, I was like, yes,
Yeah.
yes, I can. And I went back to my desk and I Googled how to build an international client management team. And
That
that's
was
how that
before
started.
ChatGPT too,
Yes,
so it was
I
even
know, yeah,
harder.
you had to figure that out. So that was my memorable moment, and that was in a PE-backed board situation. Ed,
Go Hawks.
lightning
All
round
right.
intro.
So I'm the old person of the group. Had a
So
chance to work
wise.
with had a chance to work with both Rory and Emily at multiple PE backed companies, and overlapped with all three of us overlapped at one that was backed by Primus Capital back in the early 2010s. But I've spent most of the last 25 years of my career in private equity backed businesses as a chief executive officer, chief operating officer, chief financial officer, and then interim chief technology officer, chief revenue officer. So I've pretty much done, if it's got an officer chief attached to it, I've managed to sit in those seats. Have worked with four different private equity firms over that period of time, both working at the PE level as a kind of a CFO in residence with some of their portfolio companies, as well as being picked up and dropped into companies that usually needed a little bit of help and guidance and direction. Have spent the bulk of my career in financial services or financial services related companies. Although I had a stint in restaurants, I had a stint in again with Emily in digital marketing. So, the private equity world can be pretty varied, and they invest in pretty much anything that has a chance to make money. And kind of history history lesson. I was involved in a situation where we were getting deposed. So there was a lawsuit amongst a number of folks in the investment. So it was a pretty sticky situation.
I might have been in that.
You might have been involved, and my deposition was used as a training film for a major law firm on how to answer the questions consistently and not get rattled under pressure. So I'm kind of proud of that. I subsequently, kind of fun fact related to that, because of that lawsuit and the kind of the period I was in my career, I actually went back to law school in my 30s, and then subsequently have passed the bar exam, have now admitted to practice, and I spend most of my current time working as a chief financial officer or doing consulting and tax consulting work and tax attorney work for folks in the Pacific Northwest.
And just for the record, what do all the letters behind your name stand for?
I spend way too much time studying for tests. That's what they stand for.
Okay. Rory.
Yes, Rory Leaphart. I'm a Pisces. No, I'm kidding.
I like long walks on the beach.
Yeah, exactly. Boy, yeah, I've been in financial services for 20 years, both as an asset manager as well as an executive operator, and kind of many points in between. If I were to typecast myself, I'd probably be identified as a CFO for small to medium-sized private equity-backed companies. Like Ed, I've worked for 4 different private equity sponsors through their operating company. Cumulatively been involved with about a dozen or transactions, about $1 billion in transactions. And fun fact, I suppose you could call it, maybe at the time it wasn't as fun for me, but I've sold the same business 3 times. And actually that was the point, maybe about almost 20 months ago now, where I decided to kind of pull the plug on, for the moment anyway, being an executive in operating business, and started doing a lot of consulting for businesses and working as more of a fractional CFO. So I've had a lot of cool exposure to early stage businesses, family offices, manufacturing companies, and a lot of different points in between. So, I met Ed and Emily, met you guys, speaking of first, third person, whatever. Long time ago. I've known Ed for 20 years now. Ed's been a mentor, friend, confidant, all of the things in between in my career. And, thanks to Emily, we've kind of come together again as a unit and said, hey, let's put something out to the world about private equity and our experience cumulatively in it. And just, really excited to be sharing that with the world.
Beautiful. All right. So now the listener knows who they're talking to here. PE 101, like lay of the land. Part of my brain was like, what was there before private equity? So in other words, what gap was it filling? What role does it play in the economy or in the market?
Yeah, I mean, I'll speak real high level. It's kind of in the name, right? It's you for sources of funding for any business, you look to outside capital a lot of times. So whether it's a bank to lend you money, or it's issuing stock for the public, like you, me, and millions of others to buy little slices of the company. Those are the 2 that most people think about. But private equity sits in a spot that is what the name implies. These are private companies taking private positions in your company, and partnering with you to help you grow your business in large part.
Yeah, historically, if you go back 100 years or so, which is really, private equity's been around a long time.
Yeah.
But if you go back 100 years or so right around the Great Depression and the stock market crash, you built a business one of 2 ways. You either, went friends and family and had, family money, and you raised money at the local Rotary and Masonic temple and all that other stuff, and kind of
Pass the hat around at
yep,
church. Yeah.
and did the bootstrap, or
Yep.
you went public, and there was really nothing in the middle. You basically were a public company, or you were a closely held family business. Once we kind of transitioned past the Second World War into kind of into a much more a much more diverse economy, there was a need, as Rory said, for the to raise this capital, and it was too big for the friends and family thing. And going public has become, over time has become incredibly expensive,
Yeah.
incredibly difficult to maintain compliance. So a lot of times,
Too many
even
damn
back
lawyers involved,
too
man.
many
That's
damn
what it
lawyers. Yeah,
is.
it's definitely that, plus too many regulators too. But you go back into the 80s, and really that was when private equity really started taking off. So prior to the
Whole
80s,
LBO thing that
yep,
people speak of,
you
right?
could you had a lot of small public companies.
Yeah.
I mean, there was a ton of small public companies, and the American Stock Exchange was popular and stuff like that. In the 80s, all of a sudden you started seeing these big aggregators like KKR pull in, which is Kohlberg Kravitz Roberts. They started pulling in a lot of institutional money and going, we can get a better return because these public companies aren't really well run, and so we're going to take them private. We're going to buy all the stock. We're going to take them private. We're going to put debt on. We're going to try and optimize their operations. And that started
Yeah.
at like these big companies like RJR and Nabisco. And that same model over time really started working its way down into the mid market,
Yeah.
especially as you start looking at like the stock market issues around 2000 or so, and you had Sarbanes-Oxley come in, which really made
Yeah.
being a public company very expensive, and private equity has become the primary way to raise capital
Okay,
for small
so
mid-sized
let's
business.
pause there. So private equity is for a business who wants or needs outside funding.
That's correct.
Traditionally, it was from family and friends, or you went public. Private equity offers another option.
Yep.
Got
Okay.
it.
Okay. And this has been around since like first private equity firm was when?
I
Late.
think the first, like, I think the one that people think of as the first private equity deal is way back in like 1946 with J.H. Whitney and Company, and that was kind of the impetus, and the run up started in the 70s,
Okay.
and so that became much more of a bigger part of our global economy. Now there's 4,000, 5,000 private equity firms globally, $5 trillion of assets under management, which we'll talk about later about assets under management. But if you want to think about that in terms of like comparables, that's the GDP of Japan and a lot of other countries in this world. So it is foundational now, really. So, hence the reason why more information needs to be shared with the world about this environment, because it's here to stay, and it's a really I would say, macroeconomically, it's not cyclical. It's there all the time, as opposed to, stock markets ebb and flow. Private equity is always there.
And I think the likelihood that a company goes with private equity versus going public is much higher. So if you're listening to this and you're a founder or you're on a leadership team, the chances that you will be involved with private equity in some way is much greater than you going public with an IPO.
Yeah, I would totally agree with that. Far greater. Yeah.
Yeah, I was about to say, and you're likely to, even if you do go public with an IPO, you're likely to stage through private equity or venture capital to get
Yeah,
there.
Okay.
for sure.
Okay. And then you mentioned it, Roy. So assets under management, which is an acronym AUM we'll use over and over again, means what briefly? And then what is the number that the private equity kind of footprint represents today?
So I'll start with the second question first. It's so big. I mean, $5 to $10 trillion of assets under management, depending on how you measure it. But assets under management simply means the dollars that these private equity funds have to invest in businesses and other assets. So assets being businesses primarily, but there's also portfolios of loans and things like that could be considered investments for private equity funds.
Okay. So the money under their management, under their
Yeah.
control, like running through the private equity ecosystem
Mhm.
is 4 to 5 trillion with a T today?
Think about it like if you're, back when I was young, I got like a $5 allowance, probably till I was like 14, actually. So I was not a
Dang.
very savvy negotiator with my parents. But if I'm walking around on Saturday with $5 in my pocket, that's my assets under management. I don't own any other stuff, but that cash that I have to spend on comic books or baseball cards or whatever it may have been, that's my assets under management. And how I invest that, I hope to get a return on it. I was not a very good investor, so I bought that kind of crap, and it was pretty much depreciated to zero at the beginning. So, but yeah, I've learned a lot since then. I am a professional now, but
Okay, beautiful, beautiful explanation. Another acronym got thrown out, LBO. Is that important to cover now?
why not? Ed, you want to take that one?
Yeah, sure. So LBO is leveraged buyout. And so that's what happens when a private equity firm takes a look at a company and says, we're going to buy the company. And the sellers of the company generally will get cash. However, the buyer of the company, instead of writing a check for, let's say, $100 million, writes a check for $25 million and borrows $75 million from either other institutional investors, banks, or issues bonds. And then they utilize the cash flow from the business to pay off that debt, to service that debt. And so as a result, they get to control a $100 million asset with only $25 million of equity, and the rest of it is leveraged, and they bought it out, therefore leverage buyout.
Yeah.
Okay.
Yeah.
All right.
Leverage equals debt in terms of use of capital. And I think that one of the things that is associated with leverage/debt is just risk, right? If you put all of your own money into something, you can kind of control the payback time frame and kind of how much and things like that. But if you take on debt from a bank or another private credit fund or however you want to do that, you're on their terms. You have to agree to their timelines and their required returns. In most cases, that works out well. If you're the private equity group and you put down a small sliver, as Ed said, you get the benefit of the whole asset. Well, once you pay off these clown banks and private credit funds, then everything's there for you. So that would have been a sweet deal. However, if things don't go as planned and you have these obligations to your bank or your other credit provider, your debt provider, that's where things can get pretty hairy. So therefore, when you think about LBOs, that's how people associate it. They think about that as like, ooh, private equity, super risky, all this, that, and the other thing. That's what they're associating that with.
Okay. All right. So we've got PE firms are a way to get money into a business. They've been around since the 40s. They really took off in the 70s. They now represent what a technically term is like a crap ton of money in the market.
Yeah.
And there's this thing called LBO, which is kind of representative of just how you structure debt and how you structure different deals and how you can infuse capital in there, which we'll get into in other episodes, but that's one example of that. Ed, you mentioned like KKR. Who are some big players in this space? Like when you say, okay, in the PE world, here's like your big boys, or here's, the different types of PE firms you can have.
I mean, I would tend to, there's, like Rory said, there's thousands of PE firms now. But KKR is probably they're like the cutting edge foundational kind of prototypical firm. But you've got, I mean, I'm just thinking I've got so many kind of running through my head. And the challenge is you used to have a very, obvious split between like, this is a private equity firm, this is an investment bank, but now like the investment banks have their own private equity firms or funds. And so it's all starting to get kind of mishmashed together. But the Blackstones, the KKRs, Rory and I both worked with Lone Star Funds, who's a huge private equity firm.
Yeah, Apollo, Cerberus,
Apollo,
the three-headed dog. I remember Ed and I used to joke about that one, but yeah, Apollo, Cerberus, Ares, man. I mean, there's a lot of them out there. And when we're talking about the biggest ones, we're talking about, $400 or $500 billion under management. And so, maybe the next question is, well, where the hell do they get all that capital, right? So when you think about private equity funds, they're just like other businesses that require capital to go do the things they do. It just so happens that private equity funds are existing to make investments. So the folks that that they serve to make those investments tend to be called limited partners, LPs. You'll hear that a lot. You'll see that a lot. What is an LP? Well, an LP is a typically an institutional investor. What's an institutional investor? It's usually a very large fund of could be retirement funds from a pension, could be sovereign wealth funds, could be university endowments, insurance conglomerates. Really, what it is it's these massive amounts of capital out there that we as consumers or individuals usually pay into. We're paying into a retire, or we're like accumulating in a retirement plan, Social Security, whatever kind of stuff. Like, so that money all needs to get invested somehow. Otherwise, as time passes, the value of that dollar that's sitting there goes down with inflation, right? So they need to keep making a return on that money. So where do you put it? Well, they put most of their money, just like most people, into public equities, some very safe bonds, and other things like that. But they have allocated to alternative investments, private equity, as well as other things, sit in this world of alternative investments typically. So these large endowments and university fund, pension funds and sovereign wealth funds, they allocate money to private equity. And so that's where private equity gets their capital. They invest that capital on behalf of those LPs, and they return profits to those LPs, which then in turn theoretically funds the retirement of teachers and pensioners and government officials and sovereign wealth funds and wherever else it's going out of the sovereign wealth funds too. We don't know, but that's kind of how it works. It's basically just follow the money around. It's money is going through various points to come back with a little extra, but that extra is being made off of somebody else and redistributed basically. So.
Yeah, so we have a chart on this in our book, On Ramp to
Yeah.
Exit, but there's like the middle level, which is kind of the PE firm level, and then above that would be the LP, so limited partners that Rory just mentioned. And
Yeah.
like to think about that in a real example, it might be, you mentioned pension funds. So a pension fund will make, a dozen investments for a series of decades, right? Because they're talking about
Yes. Yeah. That's
decades
the
and
way to think
decades and
about it, Emily,
decades.
is you're looking at decades long obligations to your pensioners,
And a
or
relatively small percentage of their investments will be to private equity funds
yeah,
because that's riskier. And so they're like, we're not going to put our whole thing
and less liquid.
and less
exactly. That's
liquid.
key right there, what Ed said. Yep.
But we want some kind of alternative, maybe some more aggressive. We
Mhm.
want
Higher returns.
diversification in
Yep.
our portfolio, da da da. Da. So maybe like sub 10%, like sub 5% even will be allocated to private equity investments. So they will fund the private equity firms, which in
Mhm.
turn, so LPs on the top layer, PE firms in the middle, and then below that are these portfolio companies,
Yeah.
or what most people would think of as like companies or
Yeah.
businesses
Yeah.
that are saying, yes, I want to take that private equity funding because I need external or I want external funding. And that's kind of
Yep.
like the circle of life, Simba, for the PE
Hmm.
world. Okay. So in terms of how a PE firm makes money, I think that that's important to understand.
Yeah.
So we have the LPs on the top, the middle level or layer is PE firms, and then we have like these, they're called funds of companies. So what normal people think of as companies or businesses, a PE firm will group them in like groups of like
Yeah.
10 to
Yep.
15 companies and call that fund one. And then they'll
Yep.
have, like fund two with 10 companies and fund three. And we'll talk about how that works. But basically, those companies grouped in those funds are on that third bottom layer. And so
Yep.
how a PE firm makes money is they get some on both ends, right? So maybe someone, Ed, can you talk
Yep.
through like they get a management fee for the LPs and all that stuff?
Yeah. So the LP essentially is utilizing the private equity management team as a efficiency to make these investments. So private equity managers are experts in finding undervalued assets, negotiating these deals, unlocking value, structuring balance sheets. And it's difficult. They're sifting through, if you're sitting in a private equity firm, you're sifting through potentially dozens of deals a day to try and find ones that fit your
Yeah.
investment thesis. So the folks at the upper end, the institutional investors go, look, I'll pay you generally around 2% of the money I'm investing with you every year. For you to do that, for you to kind of sift through all this stuff, find these investments, manage these investments for me, just like you would pay if you were getting a managed fund at Edward Jones or something. So that's
Yeah.
these guys up here at the institutional level are really happy. It's a good deal for them to pay that 2% or so management fee on the assets every year, to have those private equity experts go through a very inefficient market in a private space and find the best deals and sift through those deals. Now, the other side of that is, and I'm not going to talk about, kind of the management fees coming into the private equity firm right now. I'll just start with the private
Yes.
equity firm then goes and invests in these companies, and the companies are managed by the private equity firm in a number of ways. There's operational efficiencies that they look to unlock, and there's financial efficiencies that they look to unlock. That strategy they go in with a strategy. I know we'll talk about this a lot more, but they go in with a strategy. When they're buying into that business, they know how they've got a plan on how they're going to get back out of it and how they're going to unlock value.
Always, every time.
That value that they unlock. So let's say they unlock $100 million of additional value. They send the initial investment back to that institutional investor and go, thank you for your $100 million. We've now made you $200 million. We're going to send you back 180 million, and we're going to keep 20% for ourselves of the ups. So we're going to keep 20 million. So now they've made 2% for just kind of managing that investment over time. And then they get 20%. And again, this is roughly, some are higher, some are lower, depends on the fund. They get 20% of the profit. So now on that $100 million that was invested by the institutional investor, they might have gotten 2% per year. So they got, $10 million on that for a 5-year hold. And then they got another $20 million on the investment, and the original investor got $180 million. Everybody's happy.
Not a bad gig.
No. So institutional investor equals limited partner, yes?
Yep.
Yeah.
Okay. So on that top layer, institutional investor or LP, and in between like that top layer and the PE firm, there's like a little cycle of money that's happening, which
little
is
2% every year or so.
Little 2%. And then in between the
Just a
PE
rounding
layer,
error, nothing big. Just
a couple million here,
a
a
few
couple
$100 million
there
on a
equals real money.
Apollo-sized fund. It's cool.
And then in between the middle layer, which is the PE firm, and the lower bottom level, which is the companies in those funds, there's a little money loop happening there, which is go ahead, Ed, which is
so some private equity firms, and I've worked for private equity firms that both do this and some that do not. But there's private equity firms that will also charge the operating company a management fee too.
Oh, wow.
So they get a little bit of money coming in from the operating company to manage it. They get a little bit of money coming in from the LPs to manage the money. So they're getting it on both ends. And then when they sell, they get generally 20% of the profit.
Right.
So they get, but that's transactional. So that's only going to happen generally once during the course of the investment.
Okay. So that's high level how a PE firm makes money.
Yep.
Okay. So then, Rory, what are some reasons why a founder or original founders would even consider private equity?
A lot of times it comes down to it's reached a point in its life cycle as the founders probably bootstrapped the business up to a certain point, and the business itself at that very moment isn't generating enough free cash to make bigger investments to grow more. Maybe they don't have access to traditional debt markets, etc. So they need outside investment. So that's a place they can go. Also, another reason why a founder might take on a partner, maybe they want to they want to monetize some of what they've built, rightfully so. If you spent 15 years of your life grinding away to build your business, you want to reap the benefits of that in some way. So you could either sell your entire company altogether to maybe a strategic buyer and, be done with it and move on, or you can sell a majority of your business to a private equity fund at a value you think and they agree on, or vice versa, is fair. And so you can take some money off the table and start building that big house or buying that Maserati or whatever. But it's a way to realize some of that investment without going through the rigmarole of taking a company public, because you could be dead on arrival if you do that wrong and time that wrong, you know. So oftentimes it is a great deal for relatively little friction to go get more capital, right? Even if you have a very fundamentally sound business, taking your company public is a massive endeavor. It's extremely costly, and it is not always a given. Private equity, in my experience, the ones that I've worked for are oftentimes very flexible in how they get a deal done. So I would say, if I were to wrap it up, it's potentially the easiest avenue of those three to get a deal done, basically. And so again, why would you want to get a deal done? One, you just need more money to grow your business. You have a new product or a new strategy or new geography you're trying to get your solution into. It takes a lot of dough to hire the people, to build the technology stack, to manage through the compliance and all that kind of stuff. You need money to do that. And so if you don't otherwise have the means to do that through your current business, you need outside money. Two, again, like I said, some founders want to take money off the table. And by that, I mean, get paid for what they've built, and doing that through selling to a private group is probably, again, the path of least resistance to doing it. Now, again, we'll talk more about what that means once you do lock arms with your partner, but getting to the point, I've been through a lot of private equity deals, and sometimes they can be pretty straightforward, believe it or not. So,
Okay, those are some reasons why you would engage with a PE firm. Ed, anything else to add?
Well, I think the other piece is you do run into a situation where it's, could be a family-owned business or closely held business, and partners are no longer getting along. So you need to be able to make a transition of one or more of the partners that
Gosh,
were
yeah, good
founders of the
point.
business. Been in that situation before, and also you've got situations where
I forgot it's not all rainbows and unicorns.
no.
Forgive me.
And so there's a distress side of this too, and there's private equity firms that specialize in distress where you've got situations like that. You got situations where founder may need to get liquid because they've got a family situation, or they're a divorce, or an illness or death, and so private equity firms, as Rory said, it's a very low friction comparatively, and quick to close comparatively.
Yeah.
And so they could come in and kind of provide that liquidity to founders, families, could save the business in some cases if there's a need for additional equity, but the business has, a future ahead of it. And so there's the distress side of private equity as well. And that's a pretty lucrative piece of that business.
Yeah. And it actually, that's a great point. It's worth talking about that not all private equity groups are the same, right? Like, you have private equity groups that focus purely on technology and let's call it, services businesses. And you have others that only deal in industrial and manufacturing type businesses. And furthermore, like Lone Star Funds, I'll go out and say it, who we've worked with, they look for a lot of times financial services, but undervalued or sort of distressed scenarios, so they build their business in what they do best. And again, these private equity firms are made of human beings. Every human being has their own core competency and the things that they are good at and they're knowledgeable for. So they build these businesses around people and then double down on the emphasis of where they put their money based on that. So,
Okay. My second to last question is, who would not be a good fit for private equity? So if someone's listening and it's like, look, if you want to maintain a lifestyle business, if you want to maintain control, like, who is just this?
You just did on two of the big ones. So
there you go.
If you're going into a PE backed deal, couple companies that should not be looking at it is if you're too small. And by too small, I'm saying equity value under 10 million. You're probably going to be too small for private equity. You're going to have to go to hit the Elks Lodge and pass a hat around at church, to raise additional capital. That's still friends and family. If you want to run your business as a lifestyle business and you've gotten used to making, $1 million, $1.5 million a year, working 35 hours a week, it ain't going to be that way anymore. And if that's what you're looking for, you'd best exit, if you're going to go private equity. And the other piece where it isn't good is, and I know we'll talk about this more, is if you've got a problem and you're trying to sell out from in front of that problem and you don't think the private equity guys are going to find that problem. They're going to find that problem during diligence. They've generally seen it all. And if they don't find it during diligence, they're going to find it after diligence. And so if you're trying to get out and you're not being transparent about what the business's opportunities and challenges are, that's going to be a bad fit ultimately for that private equity partner and you.
Yeah. Well said. First and foremost, if you're a fan of total control of your business and you're not willing to cede that, private equity ain't for you.
All right. What is private equity not? So Ed, you alluded to this just a second ago with VC, but just what are the things that private equity gets confused with? We want to clarify.
Yeah, so venture capital, and I'll use the example. Venture capitalists look for 20x, 30x returns, and they expect 10% of their stuff to hit. Private equity looks for 20% returns and expects 90% of it to hit. So you've got a different risk profile that those two types of investors are looking for. And so if you're a high risk kind of early stage business that's rocket ship to the moon, you're probably not a private equity. You're probably a venture capital candidate. The other thing that private equity is not is generally a passive investor. Private equity is looking for ways to either operationally or financially enhance the value of that business through efficiencies, and that's where they're going to bring their expertise in. And if you're expecting someone who's just going to hand you a big check and walk away and come back 5 years later, that ain't going to happen. They're not that. They're an active partner in the business.
That's the angel investment seed round action. That's not private. Yeah. Well said. I mean, it comes down to really what you're used to and how much you control, and ultimately, how much, honestly, from what I've observed and experienced, how much you're willing to kind of put your ego aside and move your business forward with a partner. Because again, oftentimes the private equity groups see things beyond what the founder sees in your business, and they want to work with that founder and the management team to even potentially pivot the business in a way that everyone thinks can make a lot of money. But sometimes if it's not the right chemistry or dynamic off the jump, that's going to be a problematic road. And I think that the founder generally controls that destiny on how they respond to change and the input of others, if you will.
Yeah, I think that's a good note to leave on, because the whole premise of this is it can be, when it's set up well, it can be a win-win-win scenario.
Everyone can hit home runs. Yep.
Life-changing. It can be lucrative. You can win,
Absolutely.
the PE firm can win, your customers can win. So when it's done right, it can be a great move to make. And part of why we're doing this podcast is just to arm you with that knowledge, so you know what's going on, eyes wide open, what you're getting into. So we'll call that a wrap for our first episode, but that was literally just the tip of the iceberg, the very tippy top of the pyramid type of thing. So we're going to expand on all of these topics and more, and just make sure that you have everything you need to make an informed decision. And right now we're planning on every other week podcast, so it'll drop every other week. But if you like what you heard here or want to hear more and learn more about this, then hit subscribe so you don't miss an episode. And we will catch you next time on the Private Equity Experience podcast.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.